Nvidia just posted the greatest quarter in semiconductor history, $68 billion in revenue, earnings that crushed every estimate on Wall Street, and the stock crashed 5%, wiping out $260 billion in a single day. That's more than the entire market cap of Intel. After this video, you'll understand why the most profitable company in AI is being punished for perfection, and what it reveals about a massive shift happening right now in global markets. Imagine training for the Olympics your entire life. You show up, break the world record, and the judges shrug. That's Nvidia right now. The company reported $1 billion in Q4 revenue, up 73% year over year. Data center sales surged 75% to $3 billion. Net income hit $43 billion, nearly doubling from last year. Gross margins held at a stunning 2%. And the forward guidance? $78 billion for next quarter, blowing past Wall Street's $8 billion estimate. By every measurable standard, this was a flawless performance. So why did investors respond by dumping the stock at record speed? The answer reveals something far more unsettling than one bad trading day. The obvious explanation is sell the news. Investors bought the rumor, now they're taking profits. Simple. And sure, there's a pattern. Nvidia stock has dropped after 5 of its last 8 earnings reports, even when it beat estimates. But that explanation is lazy. It treats the market like a coin flip. The real story is that something fundamental has changed in how Wall Street evaluates AI. The rules of the game shifted, and Nvidia, despite winning by every old metric, is losing by the new ones. So what's really going on? Here's what nobody is connecting. Big Tech has committed to spending over $600 billion on AI infrastructure in 2026 alone. Microsoft, Google, Amazon, Meta, they're building data centers at a pace that makes the dot-com era look modest. And Nvidia is cashing every single check. That sounds like a dream, right? Except Wall Street is asking a question that Jensen Huang doesn't want to hear. Where is the return on that $600 billion? Here's the uncomfortable math. Cloud providers are Nvidia's top customers. 5 companies account for roughly half its revenue. These companies are spending hundreds of billions on GPU clusters, but their AI revenue is a fraction of that investment. Meta's AI ad optimization is working, but Google's AI search monetization? Still unclear. Amazon's Bedrock platform? Growing, but nowhere near justifying the capex. Joanne Feeney at Advisors Capital Management put it bluntly, there is growing concern that the ultimate revenue from AI will simply not keep up with the capex spend. Jensen Huang fired back on the earnings call, saying compute is revenue without tokens, there's no way to grow revenues. But the market heard something different. It heard a chip seller telling his customers they need to keep buying chips. And that's when the alarm bells went off. But that's only half the story. Here's the twist that makes this truly fascinating. While Nvidia was posting record numbers, a quiet revolution was happening in the rest of the stock market. Investors have invented a new playbook, and it has a name: the Great Rotation. Since January, technology stocks have been the worst performing sector in the S&P 500. Energy, materials, and consumer staples are leading. The Dow, which has far less tech exposure, is up 3% this year, while the Nasdaq just posted its worst month since March. Craig Johnson, chief market technician at Piper Sandler, downgraded the entire technology sector from overweight to neutral. But here's the part that will make you rethink everything. The catalyst wasn't Nvidia's earnings. It was Anthropic's launch of Claude Cowork in late January, an agentic AI platform that can automate legal discovery, financial auditing, and HR management with minimal human oversight. That single product demo vaporized $2 trillion from software company valuations in February alone. The irony is devastating. AI just proved it works, and that proof destroyed more stock market value than the 2008 financial crisis wiped from the banking sector. Nvidia built the engine, but the engine just crashed into its own customers. The better AI gets, the less valuable the software companies that pay for Nvidia's chips become. It's the most paradoxical feedback loop in market history. If you own an index fund, and statistically, you probably do, this affects you directly. The S&P 500 has roughly 30% exposure to technology stocks. When the market rotates away from tech, your retirement account feels it. But here's the counterintuitive opportunity. The companies that AI cannot disrupt are quietly having their best year in a decade. Caterpillar, Valero, FedEx, stocks that nobody puts on a thumbnail, are outperforming Nvidia in 2026. Are you positioned for the world where AI's biggest victim is the industry that built it? Drop a comment with your honest take. Here's my prediction. Nvidia will keep posting monster quarters. The revenue will keep climbing. But the stock may not follow because the market is no longer pricing Nvidia's present. It's pricing whether its customers can turn $600 billion of AI spending into actual profit. And if they can't, the greatest chip company in history becomes the most expensive warning sign Wall Street has ever seen. The question is, are we watching the peak of AI hype or just the intermission?